Wayne, when we spoke to you in March, you told us buy gold. You nailed that call. What is the trajectory now for the yellow metal?
Yeah, good morning, everyone. Look, I think gold begins to start to have a period of consolidation while we work out what the next steps are for some key variables. There's been a few mixed messages from the Fed over the last couple of days, and I think that's what's seeing gold consolidate around these levels. To see gold move materially higher, what we need to happen here is we need that real interest rates in the United States dip deeper, even deeper into negative territory than they are today. If you look at the 10-year tips in the US, it's around the negative 1% or so. If real interest rates were to move to around negative 1.6%, you could see gold moving towards the sort of 2,300 sort of mark. The other key point, of course, is the direction of the dollar. Clearly, the dollar is now on the back foot. We expect that the dollar will continue to depreciate against some of the major currencies, such as the euro. That will only add further impetus to gold to move higher. Of course, if we saw a sort of euro-dollar trading around the 125 or something like that, that would also be consistent alongside of deeper negative real interest rates. That would also be consistent with the gold price moving to around the 2,300. So we have the gold price consolidating around the 2,000 for now, and then we need to see the key messages from the Federal Reserve, as well as the evolution of inflation expectations in the US to give us a better steer to which direction real interest rates are going to go from here.
So some consolidation in the short term. If you're an investor that doesn't yet have exposure to gold, what would be your recommendation? Do you want exposure to futures contracts? Do you want exposures to ETFs or the miners themselves?
Yeah, I think that's a really interesting question. I think from an overall short-term performance point of view, the key thing for gold currently, and the reason why we remain bullish gold, is because we see it as a very good hedge against any uncertainty as we approach the US election. And as I say, potentially the risk of more actions by the Fed on the dovish side, which would then push the gold price towards our upside case of around the 2,300. But when we reflect on how would this impact gold equities, well, gold equities over the last decade have lagged the gold price from a performance point of view. We are starting to see them catch up. So we do like select gold equities, particularly the large cap names, where we see that they have been very prudent in some of the investments they have made. This means that they are likely to be able to make more distributions to shareholders over the coming year or so. And that is probably very positive for gold equities as we're going forward. But we have to remember that volatility of gold equities is almost double that of gold. So the gold underlying should be considered as a hedge against uncertainty in the market and other shifts, whereas gold equities is very much a play on gold prices remaining around these levels, if not moving higher from here.
When we look at some of the data out of Europe or the US when it comes to manufacturing, it seems like there are some green shoots, and we're certainly seeing that here in China. How does that feed into your views on base metals and whether there's more upside now as we look towards the end of the year? Yeah, look, base metals have performed very, very strongly, many of them back at pre-COVID levels. Effectively, manufacturing has surprised to the upside in China. As you say, we're seeing green shoots in the PMIs. We expect the global recovery to continue into next year. We don't expect any broad-based lockdowns to come from here. Yes, there may be some regional ones. We're seeing spikes in various places where they're having to implement greater restrictions. But broadly speaking, we expect the world economy to continue to recover. China is leading that recovery. China is one of the biggest importers of things like copper, nickel, zinc. And so consequently, manufacturing will continue to pick up through the second half of the year. We also expect that trade, which has been a bit sluggish because of the delayed impact of COVID-19 in Europe as well as in the US. We expect that trade will begin to pick up as consumers come back to the shops. And so consequently, that's a very positive environment for base metals. So we would expect that there is further upside, albeit we acknowledge that the recovery has been very strong to date.
Wayne, it's Rishaad in Hong Kong. We saw some quite dramatic moves. The dollar, as you predicted before, weakened, but a lot of people have been saying that. Now, it's in the recent days, it's made a bit of a rebound. Is the greenback on a picnic at the moment, or do we anticipate further weakness in the pipeline?
I would expect further weakness to come to fore, Rish. Largely, though, it's a little bit like the gold view. I think that the US dollar has a period of consolidation. We've clearly moved into a new trading range of this 115 to 120 type of range. But the drivers that have weakened the dollar should continue to weaken the dollar as we go through into next year. And those drivers are as global growth broadens out, as the recovery begins to move into other countries. As we said earlier, the recovery begins to broaden out in the US and also Europe, but moreover, also into other emerging markets, and so in particular Asia. And we know that yields on investment are higher out here in Asia than what they are in the US in many areas. And so we expect that as people become more confident that the recovery is well underway and potentially we have a vaccine for COVID-19 in the first half of next year, then we expect that the dollar can continue to weaken as people look for alternative investments abroad. And so I would say that something like Asian currencies should continue to strengthen against the dollar on a 6 to 12-month basis.
Wayne, just looking at some of the majors and looking at the euro in particular, the euro's done pretty well against the dollar, and it's unsurprising, and it should have happened before. We've got a chart here, you can't see it, but it's essentially showing how asset managers have been piling in to the euro, making bullish bets on it for the last couple of years, really. It's now, we've got bullish bets actually the highest on record. I guess that moves the needle there. So if the euro rises, how much of it is down to this, and also some optimism of the euro area getting its act together with this financial package that they're talking about, and perhaps a bit of fiscal consolidation within the countries which share the single currency?
Yeah, I think that generally speaking, Europe looks like it is going to outperform the US over the second half of this year. And I think that's the strength in the euro that we're seeing, that you would expect that given the fact that the levels of numbers of people who on a daily basis contracting COVID-19 tend to be lower in Europe at the moment than what they are in other countries such as the US. And that entail with the fiscal packages that we've seen have given a lot of positive sentiment. What I would say going forward, though, is that we could expect that the fiscal boost that comes in Europe is actually more geared to the end of 2021 into 2022 than it is very much for the short term. So that's where we see quite a bit of consolidation in the euro at sort of current levels. And then as those packages begin to come into play, then we expect that the euro can actually move higher from there. But at least at this point, you would expect some consolidation. Let's not forget that at the same time, the US is showing a lot of policy differences on stimulus there currently. So we would expect that at some point there will be some agreement on those fiscal packages. And so consequently, that's where we see the euro dollar, for example, just consolidating in this sort of 115 to 120 range over the next 6 months, Rish.